Crypto Hotep here with another investing video. We're on week 48 of the Family Portfolio and Dividends Tracker. Now, if you're unfamiliar with this concept or these videos, feel free to go to week number 1 in my channel, watch that video in its entirety, and that video will explain the methodology, the thought process, and everything that encompasses what you're about to see. Basically, what I did in a nutshell is I gave my family a short list of stocks to choose from and brands that they felt comfortable with. They chose their stocks, and then we proceeded to use M1 Finance as our broker of choice, because within M1 Finance, you can create one big portfolio and then have sub-portfolios inside the main one. Why that's good is each one of my family members has a sub-portfolio within the big family portfolio of his or her own stocks. Every week we go through these stocks and we go through market events. We go through stock balances, how we're feeling emotionally, mentally about these holdings, and we make changes. We focus on dividends as well and just track the investment journey. If you like these videos, feel free to like, subscribe, comment, do all of that. But by no means is this financial advice. Please do your own due diligence when researching stocks. Now that that's out the way, we can go to before we go to week 48, let's go to week 47 and look where we were at week 47. So week 47, our balance in the family stock portfolio was $18.78 with a market gain of $49.77, which equated to a year-to-date return of 2.91% with a little bit over $1 in dividends earned. Now this week, we're boosted, right? So we did crack another milestone in the family portfolio over $1,900. $1,900 in the family portfolio. We started this family portfolio, I want to say, end of February, maybe March or so, with around 200, 250, somewhere around that amount in the balance. And now we've grown that over time to over $1,900 in not even a year yet. You know, it's something to see. And that just showcased that investing your money consistently across the long term, and this isn't even a long term, this is less than a year, but consistently investing in a market that can go up or down across the long term, it will benefit you than keeping your money stagnant in a bank or savings account. So we did crack over 1900 at 1913.42. That's the balance. Money weighted rate of return went up over 4% at 4.07% year to date. Market gain of over $69. Dividends earned of over $2 now. So let's see exactly what we have going on here. So today, let's look at from this week, or from last week to this week, we've had a little bit of dividend activity. So we had Lowe's with the 3-cent dividend payout, American Express in my portfolio with 5 cents, John Deere and Company 4-cent payout, and then good old Apple with 26-cent payouts. Now, again, if this is your first time watching the video, don't get discouraged by these small amounts. These are dividend payouts, and the key focus on dividend investing is that it's a marathon, not a sprint. So yeah, these amounts are going to be small in the beginning because your position is going to be small with these companies. The key point is you want to build up your position in Apple, you want to build up your position in Deere and Company, and you want to get your position larger, so then that way these dividend payments can also increase in size. And literally, it's just a snowball effect. These dividends start off small, just like a snowball, but as you keep gaining them consistently, that snowball effect takes effect for these dividend payments, and it'll increase more as well. But we did have our regular deposit of $15. Yes, that's also a small amount, because I want to showcase that you can build wealth with any type of investment, any type of amount of money, in general. Yes, there's sometimes where I'm blessed with a bonus payment and we'll add a little bit more money in the family portfolio, but for the most part, we keep it consistent with this small amount here, and we just take what we have and build upon that with the stocks that we own. So we did buy several stocks today. We bought some more Celsius here. We had bought Target, Apple, and then we also bought some Tesla here as well. Okay. And so let's go to our portfolio trackers. And as we all do, let's go bottom to top. On the bottom, unfortunately, is my wife. Money weighted rate of return still at the negative 8.79%. Market gain of negative $11.83. And her balance right now is about $139.40. Okay, let's look at the culprits here. So Pepsi Company is down year to date over 4.5% here. Google down over 3.25%, and then Tesla has been bleeding out over the past couple weeks, which is completely fine. Tesla stock does this normally during the year, and when it does this is when you get all the FUD about Tesla and how Tesla's dips just going to keep dipping, and you get all this noise, and that usually scares off the normal retail investor. We're going to continuously buy Tesla, as you see. So I'm not worried about this at all. The Celsius holding is down over 14%. Even though we did buy the dip on Celsius, I'm still awaiting to see some of the financials with Celsius before we do anything. But again, we are still less than a year from holding all of these stocks, and we're in it in the long term for these stocks. And the long term is way past a year. We're speaking about 5 to 10 years of holding these companies here. Okay. Let's go to our middle stock. And our middle stock are up over 9.5%, almost 10%. Market gain of $17.13. Dividends earned of 36 cents, which is cool. And then the balance is still above that 200 at 209.47. The regular star players here, Starbucks up over 24%. That's not a typo at all. 24.5% gain on Starbucks, over 18% on Costco, which is one of the GOATs. Amazon up over 4.5%. And then Nintendo just keeps trekking up for our middle and our youngest. Over 24.5% on Nintendo. But again, Tesla bringing it down over 12.5% on Tesla, very similarly with my wife's. And then Target down over 4.25%. Not really worried about this portfolio at all. If Tesla starts catching steam and we turn in the green here, watch out for our middles portfolio. Okay, let's go to our youngest. Our youngest in the double digits for gains year to date, up over 11.25%. Great to see here. Market gain over $23. Dividends earned over 5 cents. And then the balance almost cracking 250 at 49.5 cents. Similar, as I mentioned, Nintendo up over 25.25. Starbucks up over 24.5. And then again, Apple and Tesla right here, they are the culprits for the downtrend. We already talked about Tesla and Apple. We're still buying Apple. We're going to always buy Apple. Not really worried about that either. Okay. Let's look at our oldest. Our oldest is finally in the green, which I like to see. Wasn't in the green last week or the week before. So we might be seeing a little trend upwards. As you can see, it's been relatively flat for the beginning of the year. Relatively flat. And as you can see, we might have turned the tide right here. So here we go. We're up over 1.25% at 1.43% positive. $8.59 market gain with 35 cents dividends earned. And the balance is almost at 650, 647 and 4 cents. Now, similarly, Apple, Tesla, both in the negatives. We've already talked about those. Costco, though, is up almost 18%, which coincides with our middle position in Costco, which makes sense. And then McDonald's, up over 7% with McDonald's. McDonald's did have earnings. They weren't actually good earnings, kind of low guidance on the McDonald's earnings, but very similar with how I feel about Apple. McDonald's is not going anywhere. We'll steadily buy Apple all day long. And then last but not least, my stocks. I am not mad at my portfolio right now. I will say that. So my portfolio up over 5%, so 5.48% year to date, which is good. Market gain of $32.54. Dividends earned of $1.29. And I have a stock balance of about $668.47 here. So this view versus last week's view, much more green in my sectors here. So technology is still green. Some of the other sectors that weren't, like pharmaceutical is back in the green. Johnson & Johnson is carrying that load right here. You can see Pfizer somewhat about to turn the tide as well. Hasn't yet, but will. Industrials and energy, remember what I said, guys. I said industrials and energy sector will probably be carrying the torch for my entire portfolio with the new administration that's coming in. I said that before. I said the heavy hitters will be Chevron and ExxonMobil. They are still in the green here. Okay, so watch out, or keep watching out for industrials and energy. Restaurants and food are up over 7.25%, which is good to see. Coca-Cola smashed their earnings this week. They're the reasons why they are one of my favorite holdings, because it is a very long-standing company. It's a dividend company, and 7 to 8 times out of 10, they're going to smash their earnings no matter what. They have a repeatable process, a fantastic product, fantastic company model. It's really hard to beat Coca-Cola. Hershey, I'm still holding Hershey, and I'm also buying it, but I'm down over 3% Hershey. Not really worried about that. Texas Roadhouse down over 5%, and then Smucker's Company also down 4% there. But Starbucks, again, up over 23, almost 24%. Domino's Pizza up over 14%, and then McDonald's. Again, this shows you why you need to invest into quality companies, because then the daily price action, you'll kind of just put that out of your mind. When you're investing your company in long-standing and established companies, you're not really worried about the daily price swings. It is what it is. And that was what happened with Starbucks. Starbucks was down several months as they tried to find a new CEO. They found that new CEO, they got back on track, and basically did a V recovery, the price with their stock, and now you're looking at the bearer of those fruits, if you will. So all in all, my portfolio is looking pretty nice. I am not mad at a year-to-date return of 5.48%, especially with the S&P year-to-date is around 2.5% currently. So as long as we're beating the S&P, I am good to go with that. And very quickly here, CPI came out this week, yesterday, and it came out as a surprise, and markets do not like surprises, but it came out higher than expected. So the actual was 3%. The forecasted rate for CPI, or Consumer Price Index, was supposed to be 2.9%. So as you can see, trending a little bit. This was the first surprise since October. So we'll see how the market carries on with those feelings. But as I mentioned before, the market never likes surprises, but I think that they overreacted, or they are overreacting to this, but we shall see. All in all, the family portfolio for week 48, the balance $19.1342, dividends earned $2.05, market gain of $69.49, with a money weighted rate of return of over 4% year to date. As always, guys, thank you and happy investing.